Welcome to the Cheat Code, where you will get an urban approach to financial education. I'm Ralphie Wallstreet, and today is Wallstreet Wednesday, where we will break down different stocks and different trends that are happening within the last couple weeks, where we'll also be giving out some basic fundamentals information to help you learn how to trade and also with your portfolio. So let's get down right into it. How's everyone's day so far? Today's the inauguration, so I've been watching that a lot. So I was like, I got to do my episode, but it's going to be a little later because I wanted to see if something was really about to go down. So we had to see. Everything looks good. Nothing happened. So let's see how this 4 years pans out. All right. So I want to break down today more or less into how to do the market. Like, not from beginning to end, but I want to give you some key takeaways to how you approach the market. So if you think about in the aspect of buying a stock, right? So you want to buy a stock, you don't know how. So the first thing you would probably want to do if you don't want to learn how is go to someone who knows how, like a stockbroker, a financial advisor, a banker. Things like that will be how you find out how to trade without doing it on your own, where you have someone with the know-how to take care of your money for you. That's one way. Well, now it's 2021 now, so it's got a lot easier. So now you can link your bank account to a platform and invest. So you take your bank account, Bank of America, whatever, and you look for one of the platforms. There's Robinhood, there's Webull, there's Investor Brokers, there's Charles Schwab's, Fidelity, E-Trade, TD Ameritrade. I can go on for days. There's even, I think, Stash and Acorn, but they don't invest as in a full security, but fractional shares, I believe, or mutual funds, one of those two. But so basically, you want to find one of those platforms you like and take your bank account and link them, and it doesn't pull the money directly from your bank when you're making a trade, so you have to set it up to where you take some money from your bank and leave it on the platform. So you put the money, $50 or $100 on the platform, and boom, now it'll show you have buying power on that platform. So once you put that $100 in, your buying power will come up to $100, and now you can survey the land for stocks around either $100 a share or multiple stocks, multiple shares. You want to get something cheaper. So that's where the math kicks in. You got $100. You know you can't buy 3 shares of Apple. Apple's $130. That's $290. And you don't got that. $390, excuse me. But you don't have that. So you want to stick to your lane. You know how they say stay in your lane. So if you have low income into the market, you want to stay around the emerging markets or something like that, something small, or find a blue chip stock that is still underrated, or something not really fully expensive yet, or it's safe and low volatile. So you want to look into things like that. Now, what I really wanted to get, I wanted to break that part down so you understand where I'm going. So now you know, all right, this is what I got to start with. Now I can invest in some way. But to be honest, I wouldn't just jump right into investing with just that little bit of information, because you only know how to put your money on a platform, and that's it. And then from there, you're just gonna gamble and pick what someone you heard in the office lunchroom said was popular, and you're gonna buy that. I wouldn't recommend it. It wouldn't be your best decision, but people do this. It's kind of funny. Oh my goodness, amateur investors are just scary. But what I want to do is I want to break down some information today, how to pick a stock. I'm not going to give you all my tips and tricks, but what I want to do is give you enough information to give you a starting point, or to give you an idea of how the professionals really look. And let's get one thing straight. I am not a full professional. I am not Series 7 certified. I am a guy who just loves the market. I am a stock enthusiast that is just so full into investing. It is no joke. My family, I drive them crazy. Literally, everything around me has something to do with the stock market. It never gets old to me. So, needless to say, I'm pretty well capable of explaining stocks to people. So, Now let's break down to what I know to be a smart idea. Excuse me, it's like hot in here. Oh my goodness. So the first thing you want to look into when you're investing is, and these are I call them my Ben Graham tips, because Ben Graham really was one of the major pioneers of long-term value investing. And what I means is not really following the trends, looking at the intrinsic value of the company and ignoring the price. That's the Ben Graham way. That's the long-term way. It's the way Warren Buffett plays it. It's the way Ray Dalio plays it. It's the way most rich people play, because day trading, swing trading, things like that, and just gambling into the market, you lose more money within taxes and within downturns and things you didn't expect when you pick these stocks. So it ends up, your lifespan in the market ends up decreasing faster because you're not taking the full approach to learning. So these are some of the steps Ben Graham tells investors in his book, The Intelligent Investor. I read the book like 4 times, but I took a lot of key takeaways, and I want to explain some to you. So one of the things you got to realize when you're investing in a company is the size of the company an adequate size. So you got to think, like, is this company not only profitable, is it capable of scaling to the levels you want? Like, is it capable of having the growth you need in your portfolio? So you want to also look into that. Like, is the company an adequate size? Because some of these companies they sound like they're like a major company, but it's probably a little room in the back of a sub shop. They just got good call set up to where it sounds like you got to press 1, press 2 to get to people. And it's probably a small company, but their balance sheets and their bank statements would tell you that. SEC proves that. It'll let you know what a company's doing, whether it's debt, whether it's net sales or anything like that. And SEC makes them be transparent to you. So it's perfect. Another thing he says to look into is sufficiently strong financial condition. So is the company's money good? Like, is it able to put some money in research and development, pay their bills, and do they still have some money left over? And I'm talking not once in a while. I'm talking on a consistent basis. Like, Apple's financial condition is great. They're worth $2 trillion. Amazon's is great. Like, these companies have great financial conditions because they can basically do whatever they want. Like Google, all of them. So you got to look for companies with a great financial condition. Another thing is you want to have a company, I believe, and most of the top investors believe, you want to have a company with a continued dividend for at least the past 20 years. Like, you got to look into this company, like aristocrat stocks, like Coca-Cola or McDonald's, or even some of the train companies, oil companies. They've been around for like a long time paying dividends. I'm talking 100 years plus. So you got to think, this is just telling you to look within 20 years. And the SEC tells you what the dividend history is if you really look. They have to tell you these things. So it's easy to pull up a tab when you're looking at your stock and looking for their dividend history to see if it's actually stretched out that long. Because you never know. Some of these companies may have started a dividend last week. So you want to take a look at that as well. It's important. You want to make sure also it has no earnings deficit in the past 10 years. And these are like how you pick your stocks. You want to make sure they're not robbing Peter to pay Paul. Because if they're doing that, what makes you think they're going to pay you out your dividends, let alone your stock and things like that? I mean, by law, they have to do these things, but why would you want to go through the hustle of wondering that? Like, it's just unnecessary. You want to look into these things and make sure it follows it. That's why you create a criteria. It stops you and it helps screen out the bad stocks, because when you create your criteria, you'll be like, all right, this stock fits this up, it's missing that. Let me look into that and see what's going on. So it kind of helps you a lot. Like it's definitely a good way to do stock analyzing, because it'll help you break it down. Also, you should have the company should have 10 years of stable earnings. So there's 12 months in a year, and every 3 months is considered a quarter. So every company puts out quarterly earnings. Remember I told you about the transparency. So they want to let you know, because they want new investors. They also want to let the old investors know what's coming up the pipeline so they don't sell too early. They want you to, like, companies want you to keep their stock. They also want you to talk about it and be able to have more people invest in it, because that's how their companies grow too. The money you give them help them grow. So that's why they have to be transparent about everything, and that's why there has to be like a money FBI called the SEC to make sure they're on the up and up also, because they know every investor isn't a pro, and they don't want to see you get tooken or hustled. So they try to be as transparent as possible so they don't get sued too. That's what I feel. It makes sense though, and that's why I like it. It's not gambling when you can research and analyze and see what their numbers are, and where they literally open up the books for you. So you definitely want to look into that. And another thing you also want to check into to make sure, to bring back to the dividends, you want to make sure it's an uninterrupted dividend for at least the past 20 years. Like I know there's been a pandemic and things happen, and some dividends that's never got rid of the dividend. It happens, but this is like a pandemic. Some things are different. But if you look before this pandemic, nothing like this has ever happened. So their dividend should be intact. So you want to definitely make sure it's been uninterrupted. So besides for the pandemic year, maybe last year, everything else should be good if you go back 10 years on that stock's history for dividends. So it's definitely important. So if you look at the stock market, I'm only going to give you a few tips, because I look at it like this. If you really want to learn, you'll reach out to me and let me teach you what I know so you can be confident on another level, because I am making really great money investing. I'm not about to buy a Bentley tomorrow, but I could tell you my kids are straight, my family's straight, so we can handle ours because they know how to invest as well as I do. So we'll be okay. And I want you and your family to be okay. So if you got any questions, reach out. I'm always happy to help. And if you need to figure out some more information on how to create a criteria, I'm happy to help with that also. So this has been another episode of The Cheat Code, and this was Wallstreet Wednesday. So thanks again. And I'm Ralphie Wallstreet. Have a great day.